Hi, I'm Travis Story, one of the attorneys here at the Story Law Firm. Today we're talking about taxation for limited liability companies. Now, when we have an LLC, we get to do what's called check the box taxation, which means we get to pick how we want this new entity, this LLC, to be taxed. Now, in that, there's really four options. We can actually tax an LLC as a C corporation. We can tax an LLC as an S corporation. We can tax an LLC under the partnership taxation scheme. Or we can tax it basically as the sole proprietorship, meaning it's all the way passed through and it would show up on your Schedule C under your own tax return, under your personal 1040, if it's something like a single member or if it's a husband and wife and they're filing jointly. So there's really four choices with taxation for LLCs. First of all, let's look at the C corporation taxation standard. This is potentially and most notably for large corporations, those that want to have actual income withheld year to year. So we want to build the retained earnings. If you want this kind of taxation, it's for a very specific purpose. And I would encourage you to call our office and let us walk you through this step, because it's a very rare choice that we would actually do a C corporation tax status on a limited liability company. The next one that I want to address is the S Corp taxation. This is one of those advantages that you can have inside an LLC. The S Corp taxation is kind of like the small business version of the C Corp taxation. It still does pass through taxation so that every year, the calendar year or a special year, if you have that for your tax year, you would actually end up taking all of the profits, all of the excess earnings outside of your expenses, and you would deem those to be transferred to the membership of the LLC, to the owners. So you're effectively going to take all of the money left over at the end of your physical year, your tax year, and you're going to bring that home to the members. This means that the LLC, if it's taxed as an S Corp, won't actually ever owe any income tax. It will still have to file an 1120S, which is a special S Corp tax return. It would file that, but it's an informational return. That informational return is going to provide the members of the LLC, that is the owners, with what's called a K1. That K1 is going to pass through the income, which would ultimately show up on all of the members' individual 1040 income tax returns. Now, we say that to know that this gives us a pass-through taxation scheme inside the S Corp taxation model. This is important to note because it means that the corporation the LLC isn't going to hold its own profits. It's going to pay them out every year. Now, the thing about LLCs taxed as an S corporation, they do have some significant tax advantages. One is the ability to bifurcate income. This bifurcation of income allows us to pay you, the members who are the owners, who may be working inside the LLC, two ways. The first way is as an owner, and we'll talk about that in a second. And the second way is as the actual worker. So if you are working inside the business, we can pay you according to whatever your job function is. We can say your job, a reasonable salary for that might be, let's say, $50,000 a year. If it's $50,000 a year, then we would pay you that in a salary type situation. That can be 1099 or W-2, but we would pay that consistently, and that is the income that you earned for the worker hat, as it were. Then we will pay you something as an owner. So for ease of the math and simplicity, let's say it's a single member LLC. So I, for example, would be both the worker and the owner. If I paid myself $50,000 for the worker functions, and then let's say we made a $50,000 profit at the end of the year, that would be my owner function that I would take that, and that would be what reports on the K1. And here's the awesome benefit. When we talk about being self-employed, we often hear about the self-employment tax. Effectively, this is the 15% that normally is split between the employer and the employee for things like Social Security and Medicare, Medicaid tax. This part is borne all together by the employer, which is the employee, meaning that's a self-employment tax. So the self-employment tax, or SE tax as it were, is charged on the $50,000 that you earn as a worker. It's not charged on the $50,000 you earn as an owner. Thereby, if you're talking about rough numbers, that can add up to a significant amount per year that you're not paying in SE tax. That's $7,500 that potentially you have saved just because you have an LLC taxed as an S corporation. This is an incredible benefit to you, and this doesn't touch any of the other potential tax savings tips that we can potentially put in place for your entity. It's just the cream of the crop. And to right there say 15% on that portion of your income that we can bifurcate is a huge advantage, and one of the best reasons why you should consider an Arkansas LLC taxed as an S corporation. Now, the other two tax schemes that are still available, the partnership taxation and the sole entrepreneur taxation model, are both available. The partnership taxation would just split the income straight to the different partners if you had multiple people, multiple members inside your LLC. And the sole proprietor taxation would just pass all of it straight to the individual, or if married, if we had a 50-50 ownership and we're filing jointly, we could go ahead and do that to a husband and wife type situation. So those are the 4 keys and the 4 things to look at when we're creating the taxation scheme for an Arkansas LLC. I look forward to being able to talk with you about your particular situation and help you make this very important choice. Don't make this choice on your own. Make sure that you find someone who is qualified and understands the law so that you can make the right choice to ultimately save you tax money. I will see you shortly, and thanks so much for watching.